Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host Shafiq Morten, and as always it's great to be with you. February is not only the hottest month of the year, it's also the last month of the year in which you can maximize your tax savings. It's also the last month of the year in which you can top up your tax retirement funds. Bearing in mind that last year there were some changes to tax legislation promulgated by the Minister of Finance, Mr. Pravin Gordhan. But to help us through all of this today are Mansoor Mia and Ebrahim Rawoot. Gentlemen, assalamu alaikum. Welcome to the show.
Walaikum salam, Shafiq.
Walaikum salam.
Ebrahim, we're going to start off with you. Last year there were some significant changes to the Tax Act or tax reforms or tax savings. Can you just quickly run through them for us?
Yeah, Shafiq, it's very important because we need to understand what changes took place over the previous tax year and how that actually impacts us as taxpayers. So it was really about, the tax harmonization of retirement funds, really to take everything that we have available to us and make it very simple, make it very easy to understand. And it was really to bring everything into a perspective that makes it easier for the taxpayer to take advantage of. So it was really saying, we have three main types of retirement funds. We have those retirement annuities, which is what we as individuals would take out in our personal capacities. And then we have the employer-sponsored retirement funds, and those are traditionally pension funds or provident funds. Each of them are treated differently from a tax perspective, but now the South African legislation has come into play to say we need to treat them very simply, we need to treat them uniformly in order to ensure that we as individuals can take advantage of those tax benefits. So there was really two changes that took place. Previously, you were allowed to contribute 15%, and they use a term called non-retirement funding income, and you could take 15% of your non-retirement funding income contributed to a retirement annuity in order to maximize the tax benefit. But then people said, what is non-retirement funding income? What is retirement funding income? And this was certainly very complicated. The legislation has now come into play to say, well, the 15% has been increased to 27.5%. So there's an added benefit to individuals to contribute more. But then the legislation goes one step further and says, the contribution that you make is capped to a maximum rand value of 350,000 rand.
Yeah, Ebrahim, I think actually government was quite smart, Shafiq, when they've changed this legislation, because remember, 15% of an orthodontist earning 5 million rand, he could claim almost 1.5 million rand as a tax deduction. So SARS was losing out, or not losing out, the client was saving a huge amount of money, but yes, he could put away 1.5 million rand into a retirement fund because he was making that type of cash flow. By changing it to, as Ebrahim mentioned, 27.5% capped at 350, that means that same individual with that very high income of 5 million, the maximum he's going to be able to put in now is 350,000 and not 1.2 and 1.5. So the tax saving he's making has been limited or has shrunk basically, and in that way SARS obviously will reap a bit more taxes from that very high net worth individual. But at the same point, for that individual earning from 100,000 up until 800,000 rand, the amount he can claim as a deduction has increased substantially. So government's actually encouraging that low to middle income earner to save more for retirement by giving them a bigger tax saving.
Certainly, Mansoor. So obviously there's a lot of benefits that's involved in these changes to the legislation. And then what is also very important is, we have what is called provident funds, and provident funds have got certain tax treatments in terms of benefits. That has been put on hold until 1st of March 2018, where they want to ensure that your provident funds will be treated the same way like a retirement annuity, like a pension fund, where you are forced to take a portion of that money and annuitize it in order to earn an income. So in simple languages, there's two changes. The one is immediately in effect. It started 1st of March 2016, and that is to give every individual the opportunity to contribute to a retirement fund. We've made it simple. All you have to do is work within the parameters of saying 27.5% of my gross remuneration capped to a maximum of 350,000 rand.
Mansoor, can you distill it even further, simplify it even further for, let's say, a person like myself trying to maximize my savings and getting the best out of my retirement annuity in terms of what we're discussing?
Like Ebrahim said, when the legislation came out, it seemed quite daunting, but clients have become very comfortable with that change. And as we go through it, you'll see that it's actually quite simple, Shafiq. I'm going to use each of the retirement funds that we currently have, be it a retirement annuity, a pension fund, or a provident fund, and explain to you the impact these changes have had. One, on contributions made by the employer, what happens on withdrawal, and that's pre-retirement. If you want to access that money before retirement age, what happens at retirement, and what happens, or if it's possible for you to transfer these retirement funds from one institution to another institution, or one fund to another fund. So let's start with the pension fund. As far as member contributions concerned, as Ebrahim mentioned, the employers can deduct contributions to their pension funds up to 27.5% of their taxable income or gross remuneration, whichever is higher for tax purposes. Then the 27.5% limit applies to the aggregate contribution of a fund. Now, what that means, Shafiq, is you can't claim 27.5% if you've got 4 retirement funds, or pension fund and a retirement fund. It's across all retirement funds. So if you got a pension fund with your employer and you're contributing 12% of your gross remuneration, you could go maximize your deductions to a retirement fund by contributing to a retirement annuity, but you'll only be able to do another 15.5% of your gross remuneration. You can't go do another 27.5% into the retirement annuity. So it's an aggregate over all your retirement funds that you do have. As Ebrahim mentioned again, the cap is 350,000, but this cap includes any costs which covers risk cover. Remember, a lot of employers will have a retirement fund where your contribution of your retirement funds, a portion goes to actual retirement savings, and then a portion goes towards risk cover. So that 350,000 rand capped contribution includes any contribution to risk cover if it forms part of your retirement savings or retirement contribution. Contribution in excess of the 350,000 rand, you will be allowed to claim that as a deduction, as it would be rolled over to future years, Shafiq. Then we come to withdrawals, pre-retirement withdrawals, and that's taking money out before you hit retirement age. With a pension fund, if you leave employment, you do have the option of exercising and withdrawing that full amount paid out in cash. Yes, obviously in doing so, the tax implications are much higher than what you would have got at retirement age, basically. So you'd be able to pull all of it out net of taxes that would be due. There is a tax table that would apply to the amount of tax you're paying on that specific withdrawal.
Mansoor, just to add to that, and I think it's important, Mansoor spoke about withdrawals. As individuals, we should not even be exercising that option. You know, we
Agreed.
spoke about it in so many previous interviews. Discussions around people cashing in their pension funds, their provident funds,
Absolutely.
because they think they still have another 10, 15 years towards their maturity. Before you know it, time has caught up with you and you've insufficiently saved for your retirement because you were cashing in as you went along. 2 things, you're paying a huge amount towards the tax system, and secondly, you're actually creating insufficient savings for yourself in the years that is actually meant for enjoyment.
You're destroying that opportunity cost of what that capital retirement savings can grow to.
Definitely.
And make your retirement actually financially sustainable during your retirement years. Shafiq, then moving on to retirement. You're reaching age 55 plus and you're opting for retirement from a pension fund. By law, which was the same in the past before the change in legislation, you're allowed to take a maximum of 1/3 as a lump sum. Here, obviously, that 1/3 would be taxed based on the retirement fund tax tables, which is a bit more tax efficient in the sense that your first 500,000 is tax-free there. In terms of the 2/3 portion, it's compulsory for you to put that into a pension annuity, whether it be guaranteed or linked investment living annuity, and draw a monthly income during your retirement years. The one change that did come about was prior to the change in legislation, retirement funds under 75,000 rand you'd be allowed to take as a lump sum. it's now increased to 247,500. So if your 2/3 portion of your pension is more than 247,500, you have got no choice but to move into a living annuity. If your entire pension fund was under 247, then you could take that full amount paid out as a lump sum at retirement. And then finally, with the pension fund, with regard to transferability, you can transfer your pension fund when changing jobs from one employer to another employer without any tax implications. You could move it to a preservation pension fund or preservation provident fund, but that is giving you the option of choosing where you want your money to be managed. Remember, if you move it to your new employer, you're stuck by the new employer's fund rules as far as his pension or provident fund is concerned. And lastly, you could move it into a retirement annuity if you wanted to. Moving on to the provident fund and the retirement annuity. With the provident fund, I think the characteristics are exactly the same, Shafiq, with regard to what the member can contribute, with regard to withdrawals, pre-retirement withdrawals, exactly the same. At retirement, the options. The difference here at retirement between the provident fund and the pension fund, like I said, in the pension fund, it's a 1/3 lump sum, 2/3 living annuity. In the provident fund, the client is still able to take the full amount paid out in cash should they wish to, obviously applying the retirement fund tax tables. It does become a bit more expensive if your provident fund is in excess of R1,000,000 plus, because then anything over R1,050,000, you're paying almost up to 36% tax on that. With a provident fund, it is not compulsory for you to put into a pension annuity. That is some of the legislation Ebrahim mentioned earlier, which that is something government is looking at, but hasn't come into play as yet, and they will clarify that come 1st of March 2018, as Ebrahim mentioned. With regard to transfers, like with a pension fund, you can transfer to your new employer's provident fund or to a preservation provident fund, or even to a RA if you wish to do so.
Shafiq, maybe just to add to what Mansoor mentioned regarding provident funds, there was this huge big hype around individuals resigning from employment because they heard stories that government is going to take my retirement fund savings. And it was very sad in the end, because they took all their monies in cash, it's sitting with them in the bank account, paid a huge amount of tax, but they actually haven't found employment. And I think people should not have a knee-jerk reaction to just acting on information that they don't fully understand. All government is really trying to do is ensure that you as an individual have got a nest egg to fall back on that is going to pay you this annuity or pension or income during your retirement years.
Right.
Government doesn't want you to rely on the state for financial support. They don't want you to continue working at 65 and 75 years of age or relying on the family for assistance. All government wants to do is say, we want to streamline the whole process to ensure your retirement annuity, your pension fund, your provident fund that you work so hard for during your working years is going to work for you during your retirement years.
Yeah, Mansoor, you've dealt with all the categories, but what about retirement annuities? That's a big one, isn't it?
Shafiq, absolutely. The retirement annuity is a big one, especially for that professional, the self-employed individual or businessman where there isn't the employer-employee relationship and they're not contributing to a pension or provident fund. That's his means of claiming the tax deduction as far as his retirement savings is concerned. Same principle applies, or same changes, was where it was 15% of annual taxable non-retirement fund income. It's now 27.5% of annual taxable or gross remuneration that they can claim as a tax deduction. The capping of 350,000 still stays in place. With regard to pre-retirement withdrawal, pulling retirement annuity monies before retirement age, it's not possible. The only chance of you actually pulling retirement money before retirement age out is if your retirement annuity is under 7,000 Rand, then you're allowed to pull it out. The only other two options would be in the event of the individual passing on, it would be paid out before retirement age to his beneficiaries, or if he can prove to government, to SARS, that he is formally immigrating and leaving the country, they will allow him to pull that funds out pre-retirement, Shafiq. With regard to retirement, the same applies as the pension fund, 1/3, 2/3 rule. So 1/3 is a lump sum, 2/3 into living annuity. Again, it's compulsory for it to go into a living annuity if it exceeds 247,500. And then lastly, obviously on transfers, you cannot transfer a retirement annuity into a pension or provident fund. You can only transfer a retirement annuity from one retirement annuity to another retirement annuity. Shafiq.
Okay, Ebrahim, let's have a quick look in terms of these tax savings. What exactly are they?
You know, Shafiq, people only really start getting excited and thinking about SARS and filing of tax returns when SARS actually starts advertising for you to submit your tax return. But remember, what we're doing is we're reacting on an event that has already taken place. So if you take an example, the 28th of February 2017, that is the end of the fiscal tax period. SARS will then start advertising in July and August and September for you to start submitting your tax returns. Now, we can't react in July and September and October for an event that we have a deadline for, which is the 28th of February. So what we need to understand is we need, as individuals, we need to start getting our financial affairs in order. We need to start making that appointment with our accountant, speaking to our financial advisor and saying, what is my provisional income that I'm going to be disclosing for the 28th of February 2017 in order for me to be able to understand what I can contribute as a contribution to my retirement fund. We can't do it after the 1st of March. You know, they say it's a use it or lose it concept. And if we're going to lose it, we lose the substantial benefits that has been provided to us by government in order to, first of all, boost our retirement fund savings and also maximize the tax benefit that is on offer. And I think anyone, really, who's going to say no to receiving money back from SARS because I've contributed towards this retirement fund?
Now, Christmas in February is always a good idea.
Most certainly.
Mansoor, let's get on to something else. We've been talking about retirement savings getting tax rebates. I suppose that any contribution to these funds is going to make a huge difference.
The contributions to retirement annuities and added contributions to retirement savings just ensures that an individual will retire comfortably and enhances his quality of lifestyle, or it allows him to maintain his quality of lifestyle during those retirement years. Every additional contribution to retirement fund, one, you're getting the tax saving, and with legislation change right now, 15% of annual taxable income to 27.5%, it's giving the guys, or encouraging, to save more towards retirement, which means they will retire more comfortably, but at the same time, they're going to get much more of a tax saving by contributing to that retirement fund. I'll use a simple example. Individual earning 600,000, old legislation, 15% of 600,000, he could put 90,000 into a retirement annuity. At 600, you're falling in the 38% tax bracket. So the tax saving that he would have been making on that 90,000 is roughly 36,000 Rand for the year. That means SARS would have give 34,000 Rand of that 90,000 back to him when he submits his returns, which means that 90,000 Rand contribution actually costed him 54,000 Rand. With the new legislation, 600,000 at 27.5%, he now can put away a total of 165,000 Rand, which means his tax saving jumps from 34,000 to 62,000 Rand, which again, it's a lot of money to get back from SARS come you submitting your tax returns. Obviously, the catch here is, does the individual have the cash flow to put 165,000 Rand away into that retirement annuity? Now, from me working with a lot of my client base, what I found is, and it's probably the most opportune time for that individual to be putting more away for retirement, it's that individual age 45 to 48 plus, where at age 48 you should be bond free, because you're 20 years, assuming you bought your house at 28 or 30, by age 48, 50, you should be bond free. So that spare cash comes back into play. Your children become financially independent. They done with school, done with varsity. There's no school fees, no varsity fees for you to pay. So it's liquid cash that's now freed up for you. So the youngster, age 30, 35, still acquiring his assets, he might not have the free cash flow to take advantage of the 27.5%. But that individual, age 45, 48 plus, that free cash flow has made an appearance in his bank account. Instead of really living life in those years, I would say take a bit of it and dump more into your retirement annuity. One, you're getting the tax saving. Two, you improving your lifestyle or quality of lifestyle during your retirement years. We obviously in February, as you mentioned, a lot of people, I don't know why, Shafiq, but they leave it for the 26th 27th and 28th, which makes my life trauma over those 3 days. You can do that contribution anytime pre 28th of February, and my advice would be don't leave it for that last minute and put unnecessary stress on your life and mine. Call me by the 20th and do that top up or additional contribution towards your retirement fund.
I suppose on a lighter note, if it was a leap year, they probably would have extended it until the 29th.
Absolutely.
But yeah.
Okay, we'll look at that one, yes. Mansoor, then of course, in terms of the end of February deadline, I'm not going to say a day in case it actually is a leap year, the fact that there's also other products like there's tax-free savings accounts as well that also come into play.
Absolutely, Shafiq. Look, the tax-free is relatively new in the marketplace. When I say relatively new, it was launched 1st of March 2015. So the product's been around for just about 2 years. The tax-free saving is effectively a product which is post-retirement saving. So you're not getting any benefit by contributing or tax deduction. SARS is not going to give any money back to you by putting money into a tax-free saving product. You're allowed to do a maximum of 30,000 Rand per annum. And the advantage of the tax-free saving is obviously long-term. It's saving the 30,000 Rand per annum, where you're going to save it for, I think the maximum, Ebrahim, is 500,000 Rand in your lifetime. So it will take you roughly 16 years to put that away. But what it will do for you is give you that lump sum cash that you might require in your retirement years. So start early. Start putting away that 30,000 Rand every single year within a tax-free saving. The benefit is post-taxes. So you don't pay income tax and you don't pay capital gains tax on any profits generated from that product, Shafiq.
Ebrahim, just tell us something more about this tax-free savings account in terms of the exact tax benefits and, of course, something about the product characteristics.
Yeah, I think it's important, government again, and, hats off to them. They've introduced products to ensure that individuals, ensure there's a form of savings in them, and I think it's wonderful. So what government has done is they've introduced this tax-free savings product as an added benefit to you as an individual over and above all other forms of savings. It's a reasonably new product, and government is ensuring that people take advantage. So what Mansoor mentioned is you're allowed to put away 30,000 Rand a year. Your annual lifetime limit is 500,000. So government has created certain parameters in terms of what you can and cannot do. But the most important feature regarding this tax-free savings product is that any income that you would have earned out of this product, whether it's interest, whether it's dividends, is now exempt from tax purposes. Any capital gain that you make on this investment is exempt from tax purposes. So really we need to ensure that we take advantage of these products because it is there. But then again, it works all in line with this tax year end. So we must make sure that before the 28th of Feb, any little bit of free cash that we have, speak to your financial advisor, speak to your accountant and say, I would like to take a portion and put it into my retirement annuity because I'm going to get certain tax benefits or rebates on the contribution. And then I'm also going to put some money into a tax-free savings product capped to 30,000 Rand in order to ensure I'm not only creating a savings nest egg for myself, but now it's in an absolute perfect tax efficient environment.
Absolutely.
Mansoor, tell us something about the differentiation in the Oasis tax-free investment account.
On our Oasis side, we've literally created 4 portfolios available for the tax-free. The one would be the Oasis Crescent Balance Stable Fund, the Oasis Balance Stable Fund. Now these are very well diversified portfolios. It's a mixture of equity, property and cash, both local and offshore. And then you have got the cash component portfolios, which is your money market or Oasis Crescent Income Fund. Obviously with the Balance Stable Fund is where you probably see a bit more capital growth because you link to equity and property exposure. With the cash, the income fund, it's the interest income that you would be earning. Remember, keeping it in a normal money market, your first 23,800 is exempt from taxes. Everything thereafter gets added to your annual taxable income. But if you're going into a tax-free saving account, whether you made 23 or 100,000 rands worth of interest income, there is no tax payable on that, Shafiq.
Ebrahim, a final question. Who would this be appropriate for?
Oh, I think that's such a broad question, Shafiq, because it's literally going to be there for every individual out there, whether it is you, a new addition to the family, whether it is a grandparent gifting, funds to the grandchildren.
In my view, the best gift grandparents can give their grandchildren. It's doing that if you can afford to, that 30 every year for as long as you possibly can. That grandchild turns 20, 25 and he's got 1.2 million rand or million rand sitting in a tax-free saving account which he can pull out and buy his house cash.
And it's targeted at so many people, whether it is you, just a normal salary earner, whether it's you, a businessman, and you can take advantage. We all complain about paying too much tax. Government has put products in place for us to take advantage of these opportunities that has been presented to us. It's about how we go about doing it. So, we are in a very difficult space. We're not ignoring the fact that, people's savings ratios is significantly reduced, but we need to ensure that we start saving, even if it is small amounts, and that compounded effect of time, is just going to be a wonderful result at the end of the day. So really, we have the retirement annuities, we have the pension, the provident funds, we spoke about that. We have a deadline of the 28th of Feb. We need to get our ducks in order, get our house in order, and make sure that we start taking advantage of these benefits. And then government has said, we have an added product, which is the tax-free savings. Take advantage of that.
Ebrahim and Mansoor, shukran, thanks for chatting to us. And this concludes today's edition of the Oasis Focus on Finance show. Special thanks to our guests Mansoor Mia and Ebrahim Rawoot. Don't forget, February the 28th is the deadline to top up your retirement savings. Also, don't forget, we will have a special broadcast on the 22nd of February when the Finance Minister, Mr. Pravin Gordhan, gives us the national budget. Should you wish to watch this or any of our other shows, you can log into the Oasis Crescent YouTube channel. Contact info@oasiscrescent.com. Should you wish to call us, 0860 100 786. Until next time, I'm your host, Shafiq Morten. Assalamu alaikum wa rahmatullah.